Hello and welcome back to the channel where we demystify the complex world of finance. Ever wondered what makes a stock hard to borrow and why that can sometimes signal explosive potential? Today, we're diving deep into a fascinating microcap called Zhongcheng, ticker symbol ZCMD, which has recently appeared on our hard-to-borrow screener with some truly eye-watering metrics. We'll break down what makes ZCMD stand out and explore the mechanics of a potential short squeeze. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Show ZCMD chart/logo Zhongcheng, or ZCMD, operates in the healthcare information services sector, primarily in the People's Republic of China. The company provides healthcare information, education, and training services under its endemic brand, including patient management. With a tiny market cap of just $2 million, ZCMD is firmly in microcap territory, and its estimated float is around 1.1 million shares. Looking at the recent price action, ZCMD saw a plus 13.91% increase today, which is an interesting move considering it's down minus 31.20% over the last 5 days and a significant minus 76.29% over the past month. Volume today was 427,500 shares, which is quite low compared to its steady day average volume of 3,675,796 shares, giving it a relative volume of just 0.1x average. Highlight today is price and volume. What is cost to borrow and why it matters? So, what exactly is cost to borrow? When someone wants to short sell a stock, they first have to borrow shares from a broker. The cost to borrow, or CTB, is the annualized fee they pay for the privilege of holding those borrowed shares. Share animation of short sell process, think of it like interest on a loan. Why does it matter? A high CTB indicates that there is strong demand to short the stock, but limited supply of shares available to borrow. When the demand to short far outstrips the supply, that fee can skyrocket, often exceeding 100% or even several 100% annualized, as we'll see with ZCMD. This high cost directly eats into a short seller's potential profits and can signal increasing pressure. Why this stock is hard to borrow right now? Now, let's look at ZCMD specifically. This stock appeared on our screener because its cost to borrow fee is an astronomical 927.8% annualized. Display 927.8% large, that's nearly 1,000% per year just to hold a short position. What's even more striking is the CTB momentum. It shot up plus 169 percentage points over just the last 5 trading days. This rapid escalation tells us that the cost to short ZCMD is not just high, it's accelerating. Furthermore, there are only about 30,000 shares currently available to borrow, which is a tiny fraction of its 1.1 million estimated float. Our internal composite squeeze score, which combines factors like CTB, borrower supply, and momentum, gives ZCMD a score of 56.4 out of 100. This combination of extreme cost, rapidly rising fees, and scarce borrowable shares makes ZCMD a textbook example of a hard-to-borrow stock. Squeeze mechanics explained. So, how does this lead to a short squeeze? Short animation of squeeze. A short squeeze occurs when the price of a heavily shorted stock rapidly increases, forcing short sellers to buy back shares to limit their losses or due to margin calls. When short sellers are forced to cover, their buying creates further upward price pressure, which in turn can trigger more short sellers to cover, creating a cascading effect. With a CTB like ZCMD's, the daily cost of holding a short position becomes incredibly painful. If the price starts to move up, even modestly, these high fees combine with unrealized losses, making it very expensive to stay short, potentially forcing capitulation. It's crucial to understand, however, that a high cost to borrow does not guarantee a squeeze. It can also mean that short sellers have very strong conviction that the stock's price will ultimately fall, and they are willing to pay a premium to maintain their positions. Dilution risk check. One critical factor to consider for any potential squeeze play is dilution. Dilution happens when a company issues new shares, which increases the total share count and can reduce the value of existing shares. For ZCMD, our check found no recent diluted SEC filings like -1s, -3s, or 424Bs in the last 90 days. This is a positive sign, as new share issuance can flood the market with more borrowable shares, directly counteracting the scarcity that fuels a short squeeze, and offsetting any buying pressure. Recent reverse split watch. Another important piece of information for ZCMD is its recent reverse stock split. ZCMD executed a 1-4-3 reverse split on June 29th, which was just 15 days ago. Show text, 1-4-3 reverse split, June 29th, 15 days ago. A reverse split reduces the number of outstanding shares and proportionally increases the share price. While it doesn't change the company's market cap instantly, it effectively reduces the float. Historically, many microcap stocks, after undergoing a reverse split, tend to see renewed volatility or even a price pop within about a month after the event. This isn't a guarantee, but it's a pattern observed in some names and could be a factor contributing to ZCMD's current dynamics and potential for sharp moves. Again, please remember. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. So, if you're watching ZCMD, what should you keep an eye on? Show key metrics on screen first. Continue to monitor the cost to borrow fee and the available shares to borrow. Any further increase in CTB or decrease in supply would intensify the pressure. Secondly, watch for an increase in trading volume. Today's volume is quite low, but a significant uptick, especially on green days, could signal growing interest and buying pressure. Finally, observe price action. Can it build on today's 13.91% gain and start to reverse its recent downtrend? Remember, while high CTB can indicate squeeze potential, it also highlights the extreme risk and volatility associated with these types of plays. Don't think. ZCMD presents a compelling case study for understanding hard-to-borrow stocks with its astonishing 927.8% cost to borrow, rapidly shrinking borrowable shares, and recent reverse split. It's a prime example of the extreme dynamics that can play out in the microcap sector. We hope this breakdown helps you better understand the mechanics behind short squeezes and why certain stocks appear on our hard-to-borrow screener. If you found this video informative, please hit the like button, subscribe to the channel for more unique insights, and let us know in the comments what other stocks you'd like us to analyze. Thanks for watching, and we'll see you in the next video.